And if you go through the earnings, yeah, they started off with the banks. The banks' earnings themselves were really strong, but some of the reaction, obviously, is what happens, it seems like, time and time again. But overall, that move has moved back up to the upside. We look at the 10-year, and you can suddenly see a lot of the different banks, not just the financials, starting to move to the upside. And you look over at the financials each and every day, and it's Capital One, it's Goldman Sachs, it's Morgan Stanley. They just continue to move to the upside, the Wells Fargos of the world. So we've got that sort of on the backdrop. But also, how about this run in oil? This just continues to run to the upside, and we've watched energy. Now, it seems like we go up a little bit, Mel, and then we step back just slightly, then up. And that just seems to be the direction that we're going when we're talking about oil, because we take a look at where crude is right now as it's pushing towards closer and closer to $60 a barrel. And these beta names have been absolutely on fire. We've had nice moves out of Chevron and Exxon and the usuals. But it's that next level down where you're getting those really big hits from the Occidentals of the world, the Devons and some of those different types of names. So I think this is a little bit more broad than people talk about. I think when you really break it down and then you look at just technology itself and you look at the NASDAQ, it isn't just about technology. It's semiconductors. It's a biotech. Semiconductors and biotech seem to hit new all-time highs, it feels like, almost every day. And then we get the pullback, and then everybody gets a little bit nervous, and then all they do is reload. So I think there's a lot of reasons right now to just try to not fight the markets and just try to ride along with the markets, especially with volatility trading as low as it is right now, Mel.
I am glad that you brought up oil, because I was watching intraday crude prices, Pete, and they are pushing to intraday highs at this point. We've got Brent pushing to 62 here, and this is probably the most hated trade, or amongst the most hated trades in the markets that have gone higher. And as Pete had mentioned, energy is among the leadership groups in today's session, with the XLF up by almost 1% at this point. Lebenthal, where do you stand here on energy?
Yeah, well, I think it's a great question. Thanks for asking it, because part of why energy is high right now is because of unexpected discipline from OPEC+. And frankly, not just OPEC+, but the shale producers. Everybody has sort of stepped back and let prices go up without flooding the market with supply. That's unusual. That's a huge contributor. I also think, and this may be a little bit provocative, but I think this administration is making it very clear, not this part is provocative, very clear that they don't want fossil fuels. And the actions that they're taking are likely to raise the prices of crude oil and natural gas going forward. I'm not taking a political stance in this. I'm just simply saying if you refuse permits for pipelines, then it's going to be harder to get that supply onto market. So on the margins, that will increase crude oil prices as well. So you put this all together, and it looks pretty good for energy prices to stay where they are. Particularly, I didn't even mention demand. If demand starts picking up as the vaccines get rolled out and we start traveling again, this looks like a good year for energy, Mel.
What was that? What was the provocative part of that? Did I miss?
Well,
did I
the
miss
provocative
it?
part. No, the thing is I don't want to make it a political discussion, Melissa.
Sure.
You know, I don't want to say who's right or wrong.
Right.
It's just clearly the policies of this administration are designed to create bottlenecks in the supply of oil.
Yeah, you make it harder to drill for oil. You make it harder to get oil onto the market. It's a supply and demand issue. Oil prices go higher. So, Shannon, do you buy into that? Is oil a place to be at this point?
I think it represents such a small part of the index at this point, Melissa. It's really hard to make a case that you want to try to pick one of these major oil companies and continue to build around it. So we have very limited energy exposure in our portfolios. And the reason is that we see better opportunities in other parts of the market. I do not disagree with Jim's modestly provocative statement that the energy renaissance here in the United States absolutely contributed to the fact that we've had depressed energy prices over the last few years. You know, we have more supply. I do think that supply will continue to come online. I do not think OPEC Plus will continue to be as disciplined as they have been. You know, I think that there are a lot of things that impact those relationships that are outside of, you know, our purview. But I do think that if you're looking at your overall portfolio, where you want to be, we have, as I said, limited energy exposure. We're in EOG and Valero, like those names. But I wouldn't be adding significantly to my energy exposure in this environment, because I do think that there's going to be some cross pressure on oil prices later this year.
Yeah. We are watching the XLE push to session highs at this point, with Brent up by more than 2% right now. We're watching it tick higher. So, Jenny, I will go to you. You know, wrapped up in Jim's modestly provocative statements is the notion of inflation. And we saw that also highlighted in the UBS report where they say, you know, you ride the spike train. You saw hospitalizations. You saw stimulus come in response to the hospitalizations and the rise in COVID cases. That stimulus heats up the economy. That heating up of the economy leads to inflation. And while it may be in pockets of the economy, there will be inflation. I'm wondering if that is part of your investment thesis, because it looks like oil falls squarely into that.
Right. So with respect to inflation and our investment thesis, we're always long term. I think when I'm thinking about inflation and what the impacts on that are as we invest, what we can look to is in 2020, when the 10-year went from 1.6, dropped to about 0.5% and started to move back up. But when it dropped, what happened was it basically added 3 multiple points to the broader market. And that happened in a very bifurcated way. I think that the 3 multiple points went disproportionately to the large end of the market. One of the things I'm expecting is that as bond yields start to move back up, those 3 multiple points might be taken back out. And they might be taken back out in terms of the big names that got them just plateauing and the earnings growing into them. But for my investment thesis for the portfolio that I manage, that we all know is a dividend portfolio, kind of value leaning, it's got a much lower multiple than the broader market. So I don't think that there's risk in those stocks that are trading at a discount to the market in losing that. So inflation, you know, as it affects multiples in the market, that's how I'm thinking about it. Just one thing on energy that I think is really unique and interesting. This is a technical, but as we get closer and closer to March, when the price of oil plunged from, what was it, at 40 to 26, and then we got into that crazy thing in April and May where it went negative, that's actually, as those comps come in, there could be a big push in the momentum trade, because you're going to have really, really favorable comps coming in, both in terms of earnings and share price appreciation off of those numbers. So there could actually be a shift in a momentum, or some quantitative programs could start to push energy as we get to the 12-month anniversaries of that. Additionally, I heard that hedge funds are something like short energy 5 times more than anything else in their portfolios. So there are some technicals that could put further wind at the back of energy in this inflation, regardless of inflation and how that plays in.